Dutch dividend distributions are in principle subject to 15% withholding tax. However, under the application of tax treaties or the PSD directive, this rate can be reduced, or even fully exempt if the domestic exemption applies. This exemption is crucial for internationally operating companies, but the rules are complex. As Grant Thornton, we would like to help you navigate these rules and help you comply with the related compliance obligations. As mentioned before, 15% withholding tax is in principle due on dividend distributions. If certain conditions are met and there is no abuse, the Dutch dividend withholding tax exemption applies. Let us quickly walk through these conditions. The first condition is that the shareholder must be based in an EU or EEA member state, or in a tax treaty country that includes a dividend article. The second condition is that the Dutch participation exemption could have been applied if the shareholder would have been a Dutch resident. This usually means that the shareholder should be a corporation holding at least 5% of the shares. Finally, and the most complex condition, is that there should be no abuse, meaning the structure should be based on sound business reasons. This last condition is complex and can often lead to gray areas. Let us look at a quick example. A Dutch BV distributes dividends to its UK shareholder. Normally, 15% dividend withholding tax would apply. However, as in this example, the UK shareholder is a corporation located in a treaty country, including a dividend clause, and holds at least 5% of the shares in the Dutch BV. The general conditions of the Dutch dividend withholding tax exemption are met. Still, we must demonstrate that the UK entity is not merely interposed to avoid Dutch dividend withholding tax, or that the structure is based on sound business reasons. To demonstrate this, we look at the substance or economic activities in the straight line above the BV. This can be quite challenging if the level of substance in the UK is limited, or if the substance or economic activities cannot be detected in the straight line above the BV. Furthermore, if you distribute dividends to a recipient located in a low-tax jurisdiction or a country mentioned on the EU list of non-cooperative countries, the withholding tax burden can even increase to 25.8%. Please also note that if you apply for the exemption, you must file a mandatory notification with the Dutch tax authorities. In this notification, the taxpayer confirms that the conditions of the exemption are met. The notification must be done within 1 month after the dividend is declared. Failure to file on time may lead to fines of up to €5,514, and in cases of bad faith, even to criminal prosecution. This all sounds quite complicated, but we would like to make it a lot easier for you. We have developed our in-house template and analysis tool. With this tool, we can generate a report containing our initial analysis and discussion points in a much efficient way. Let us show you how this works. First, we send you a short questionnaire with some general questions. Afterwards, we will discuss your answers in a quick call with one of our specialists. This information will allow us to import your answers into our tool and generate a report. Our specialist will review this report and discuss any outstanding risks with you. After these steps, we will finalize and share the final version with you. You will receive a tailored analysis for your situation. This report will also provide you comfort when distributing a dividend and a full understanding of your compliance obligations. Thanks to our efficient approach, we can deliver high-quality advice in less time. So, are you interested in our newly developed Dutch dividend withholding tax tool? Or do you have any questions about the Dutch dividend withholding tax rules in general? Please feel free to contact us. My colleagues and I are ready to assist you.